So you can't have a $500,000 house and offer them $550,000 and say, I want $50,000 in seller concessions. That's just not going to work because, again, at the end of the day, the homes have to appraise. The biggest issue for buyers right now, seller concessions are becoming an essential tool in real estate negotiations. And as we navigate a shifting market, it's crucial to leverage not just price, but also concessions like interest rate buydowns, closing cost credits, repair credits, and even realtor compensation. This approach can dramatically reshape your buying and selling experience. In today's highly competitive real estate landscape, the strategic use of seller concessions can be the key difference between securing a fantastic home or missing out completely. These concessions are increasingly pivotal in ensuring both excellent representation and attaining affordable homeownership. But imagine the potential setbacks if you're not utilizing seller concessions effectively. And for sellers, offering these concessions could be more advantageous than simply reducing the price or directly addressing the buyer's top concerns: affordability. For buyers, prioritizing concessions over price cuts could very well be the strategy that lands you the perfect home at a cost you can manage. Are you thinking about buying or selling real estate or considering a move to Reno, Nevada? Subscribe to our channel and ring the bell to receive weekly updates that help keep you informed with what's actually going on in the real estate market. Like this video and drop a comment below with your questions and what you'd like to see next. So today we're going to talk specifically about seller concessions and what they actually are. And we're also going to show you what it means from the seller side of things versus the buyer side of things, because I sometimes think because they're called seller concessions that somehow the seller is giving up something that the buyer is getting from them. Let's start from the seller side of things. If you're a seller and you were selling a home where I work in Reno, Nevada, and an average price, let's say, is $550,000. The house has been sitting on the market for a while. Maybe it's taken a long time to sell. We're not getting a lot of activity. And sellers, typically the first thing they want to do is, let's just lower the price. And what you might want to do, rather than just say from $550,000 to $525,000 or do some sort of big price reduction, maybe you do a small price reduction because that will allow all the people on automated searches and people looking for your home to see that new price. But rather than dropping it $20,000, maybe you drop it $5,000 and you put in some verbiage in there about offering seller concessions. The biggest issue for buyers right now is affordability. One, they're having a hard time coming up with enough money for down payments, for closing costs. Going forward, depending on how things play out, there might be realtor compensation issues that come up for buyers now too. So as a seller, what you can do, you're looking for the same thing every time as a seller. You want to know, what are the net dollars that are going in my pocket? And how we get there, if we can structure a deal that's going to be win-win for both buyers and sellers. As an example, let's say you were a seller and someone wrote you an offer for $525,000 cash, and someone else wrote you an offer for $545,000, but ask for $20,000 in seller concessions. It's not going to be the exact same number, but it's going to be very close, whereas the seller, you're going to net that same amount of dollars on your bottom line. And really, at the end of the day, that's what you care for. Every seller wants the most money in the shortest amount of time with the least amount of headaches, and they want to make sure that legally they are protected and financially and disclosure-wise they did all the things they're supposed to do as a seller. And for that buyer, at the end of the day, yeah, the price is important. What's more important is they find a home that they really like, that they want to move into, but they also get it at a price point and a monthly payment that they can afford. Again, go back to our example. Let's make it $500,000. And if somebody puts 10% down and they put $50,000 down and maybe they have $10,000 or $15,000 worth of closing costs that they need to pay for, if they go ahead and offer maybe a slightly bit more money rather than just focusing on getting the lowest price, and they can get a credit from that seller in the paperwork that we're doing, so then that way they can keep a little cash in their pocket. Because again, in our market, if you're looking for homes, say between $350,000 and $500,000, most of those homes are going to either be older, need some sort of upgrades or repairs. There's going to be something there. There's going to be very few of them that are actually moving ready to go. And for a buyer to have that little bit of extra cash in their pocket after closing is going to be a huge benefit for them. They can also use seller concessions for things, obviously, besides closing costs, to do interest rate buydowns. You could do it for repair credits. And eventually there's going to be some things we'll talk about regarding realtor compensation. Are you thinking of buying or selling a home in Reno, Nevada? Click the link below in the video description to download your free buyer's guide packed with essential information to help you navigate the local real estate market. You can even book a call with me to discuss all of your buying, selling, or investing options. So buyers are, again, trying to focus on that price point that they're making every month. And what you can do is when they write that offer, again, we're structuring that so that they can do potentially what's called an interest rate buy down. This has been a hot button topic that you've seen now for a few years as the interest rates went up and up and up. But we're going to explain to you exactly what that is. And there's actually a couple of different kind of interest rate buy downs. There's the permanent buy down and there's the temporary buy down. So let's talk about the temporary buy down first, since that seems to be the one that gets used a little more. It's a little more common. And the one you hear about the most is that 2-1 buy down. And what that actually means is this, is let's use an example again of 7% interest rates. Right now, it's a little bit higher than that, but let's just make these numbers round so it'll be easy to understand. But if you have a 7% interest rate, and a buyer goes ahead and wants to do what's called a 2-1 buy down, what it means is that the first year of house payments is going to be 2% lower, so their interest rate is going to be 5%. And for that second year, it's going to be 1% lower, so that interest rate is going to be 6%. And then after starting year 3, it goes back to that 7% number. So that payment is going to gradually increase over these first couple of years. And a lot of times for buyers, it gives them a way to sort of ease into the house, not have to worry about if that payment's going to be super affordable for them. The way this works is the cost of that buy down is the difference in what those payments would be at that 5 and 6% versus a 7%. So I know we get the question all the time where, what if I do this 2-1 buy down and now I'm in this deal for a couple of years and that 7% rate automatically goes dramatically down to 6 or even under 6%, you can still refinance and you're not going to lose that money that you put into this interest rate buy down. That money stays there. And again, we can talk to a lender and give you specifics on dollar amounts and how it works, but you won't lose that money. So if you all of a sudden refinance it in a year, whatever money was still left in that escrow account that's being used to make up the difference in the payments will then get credited towards your refinance when you do your new loan. So there's other kinds of buy downs as well, whether it's a 3-2-1, where it's the same thing where you're doing it for 3 years. You see 1-0 buy downs where people do it just for 1 year. So there's lots of ways to help people make that initial payment more affordable for them. The permanent buy down is a little bit of a different situation. So we're going to explain this one as, let's say we have a $500,000 home price and someone goes and puts 20% down. So they put $100,000 down and they have a $400,000 loan. If you've ever heard the word discount points, what that means is you're buying a point so that you can lower that interest rate from, let's just use the 7% again, to a little bit lower. Now, the complicated part about these permanent buy downs is this, is I've talked to a bunch of different lenders this week, and if you buy 1 point, so on our example, $500,000 house, $100,000 down, $400,000 loan, 1 discount point is going to cost you $4,000. But it is not this, I buy 1 point and I automatically go from 7 to 6.5 or 7 to 6 3/4. Every lender, every loan amount, they're going to be slightly different. And there are some sweet spots because many of these lenders that are doing loans aren't intending to keep the loans. They're going to eventually sell them to investors. And so depending on what investors are looking for, sometimes paying for a point will affect that interest rate a little more or a little less. So these are the reasons why, no matter what, you need to reach out to us and we can get you in touch with a really good lender that can explain this to you. Because again, I talked to a bunch of them and they all have some variability to them. They're all a little bit different. You have to be careful when you're doing these 2 different types of buy downs. When you're trying to get credits from a seller, there are some limitations. So whether someone's doing a conventional loan, an FHA loan, a VA loan, a USDA loan, a non-QM loan, which means it might be a little bit different parameters, or even if you're doing private financing, whether you're doing a first home, primary home, second home, investment property, all these numbers will change, but it'll tell you the maximum amount of money that you're allowed to get for a concession. So sometimes they're 2%, sometimes they're 4%, sometimes they're 6%. So you can use that knowing that there's not this unlimited amount. So you can't have a $500,000 house and offer them $550,000 and say, I want $50,000 in seller concessions. That's just not going to work because again, at the end of the day, the homes have to appraise. So this is that whole thing in negotiations where we're trying to make a win-win situation where the seller's able to net the most money they can. The buyer's trying to focus on getting the best price they can and at the same time get a payment that they're comfortable and can afford. And so when you're writing these offers, sometimes it's better to say, okay, go back to our $500,000 example again. Instead of offering $490,000, maybe you either offer $500,000 or you even offer a little over $500,000 because we're in a competitive situation and you ask for those dollars in concessions, but it does have to appraise. And sometimes if it doesn't, of course, now we're in the middle of the transaction, renegotiating with that other side, trying to figure out how we could still keep this as a win-win situation. So just know there's some variability in that as well. The other big thing that you have to be careful of is here at the end is making sure real estate commissions. So we're talking about this new laws that might go into effect. And honestly, today at the time of shooting this video, we heard now maybe not July, might be at the end of the year in November. We're not sure when this is going to work. But when you have these concession limitations, you obviously only can put so many things in there, whether it's repairs, closing costs, rate buy downs. But realtor compensation is going to be now potentially another category that we're going to want to try to potentially have sellers pay for. And what we're going to be able to do, at least in my state where I live and where I work, is we're going to be able to do things like saying seller to pay all commissions. Then a seller commission would not be included in that limit on the amount of concessions that you're allowed to have in a transaction. So I know that might be a little bit confusing. And of course, every situation is going to be a little bit different and certain states work a little bit differently. I know in ours, whether you deal with title and escrow companies who do your closings versus attorneys, but just know there is going to be some workaround on some of these because, an example right now in a VA loan, if we end up with commissions, you can't even have a seller contribute to those for you. So there's going to be some weird stipulations as far as how this all goes. Long story short is this. Seller concessions are going to be a big negotiating tool in order for buyers and sellers to put transactions together so that everybody can win and the seller can get what they need and the buyer can get what they need. So hopefully, if I didn't confuse the hell out of you, By all means, if you have specific questions about all this, comment below, reach out to me directly, because again, this is going to be very case specific to whether you're a buyer or a seller, or if you even need these or not. But it's a great tool to be able to use to be able to put some transactions together that may not have always been put together. That initial offer is only step one of these negotiations. We may end up having to negotiate things all the way through. So it's very critical that whether the agent representing the seller and the agent representing the buyer and both their clients understand how all this goes. I can't tell how many times we've tried to do these kind of things and the other agent has no idea what I'm even talking about. And you're also going to want to make sure that all your verbiage is correct, that the lender's happy with the verbiage and we have a good lender, and that in my state, a title and escrow officer also knows how all this needs to be said so that underwriters and people on those lines are happy with all the verbiage that we're putting out there. Interested in learning more about all of your options for buying a home? We've got you covered. Dive deeper into the world of home financing by checking out the next video.